then the other ace up the sleeve is this other story you've been catching in February and March. It really picked up steam. The physical delivery of gold to the U.S. Now, there's a huge camp of, I mean, this is like decades long at this point, of Fort Knox skepticism, right? They think the gold is gone.
Yeah.
It's been loaned out. Fort Knox is empty. We don't have the gold. I am, highly confident that the physical gold is there. And not just that, we've been taking massive physical delivery in February and March. Those deliveries have been called from the City of London. They're coming in from Europe. And on top of that, we've got, domestic gold supply that can be mined out of the ground. That's where if you look at the chart on GDX, that is showing a very bullish behavior. So on top of that, there's gold supply inside the U.S., up and down the Rockies. Pull it from Canada too if we have to. Gold is not on the import tariff list. So if you read between the lines there, you see what's going on. But what's happening is you've got that ace in the hole if needed. This is in case of emergency break glass. Say we did break down and the treasuries start to sell off on that channel, which I think we ultimately do. I think there will be upward pressure on long-term yields, but I don't think it's right now. Eventually what you do is you remonetize the gold stack, you mark it up, you go through, you follow the Bitcoin Reserve Act. Cynthia Lummis had some details in here. The Bitcoin Policy Institute details this pretty thoroughly. All you have to do is mark up the Treasury's gold certificates from $44 an ounce up to whatever the number is. Current market price is $31.75, and it set a new all-time high today. So when you're setting new all-time highs, it usually means with your trend you're not done, right? Where does this wind up? Who knows what the number is? But all you have to do is mark up the value of the gold certificates from 44 to big number. That's going to create a cash deposit in the TGA, the Treasury General Account at the Fed. Fed is the fiscal agent. The Fed doesn't actually own the gold. They're not even the custodian of the gold. They're the monetary custodian of the gold certificates. And you think about it, how did we acquire that? How did the U.S. Treasury acquire the gold? It was in the bailout of the financial system in the Great Depression. So the 6102, all of that. That's how the U.S. acquired the gold to monetize the banking and credit system out of the deflationary collapse it was in the Great Depression. So what happens? Technically, the U.S. is self-custodying, if you think about it, Fort Knox, Army Reserve, and then it's scattered throughout some other facilities. Fed is just sitting on the paper certificate version as custodian. They're the interaction with the broader financial system. You've heard Powell use the term, they're the federal government's fiscal agent. You go through, what does that mean? It's a deep can of worms. But what they would do is essentially they would create the dollars if the Treasury instructs them to mark up the gold certificates. That creates dollars in the TGA that did not have to come into existence in a borrowing framework, right? Normal dollars, everything we've seen, the last, since 1971, right? They have to be borrowed, right? They're ledger, book accounting transactions for the federal government to access dollars. It has to get them. You can tax, right? But our tax revenue hasn't been covering spending, so that shortfall has to be funded through borrowing, right? So the dollar creation is attached to an IOU, and everything we've done so far has just been someone has to buy that IOU. QE means the central bank is going to buy that IOU, which is really the part of that process is that we need to dive into this book review series. There's a good one that goes on to it, but it's the transformation of public debt into bank money. And why does the nation state want that? When the liability becomes bank money, you get purchasing power at 100, right? Versus even a T-bill is a good example of this. public debt as money doesn't get full purchasing power. Right? Even, you hear Stephanie Kelton talk about T-bills as like different colors of the same money. They're not the same thing. Bank money and public debt are not the same thing. The public sector needs banks to create bank money to do that transformation to maximize purchasing power up to 100. But the in case of break glass that we have, like, yeah, everybody knows at this point, post 2008, everybody's been doing QE. We all know it. Everybody else in the game knows it. Um, we know that trick has kind of run its course. It can still get turned on, right? You can still utilize it, but it's not going to get, you're not going to get the bang for the buck you used to. But assuming we have the gold, the in case of money or in case of emergency break glass is to mark up your gold, which is just a pure monetization of the credit bubble, and those dollars hit the TGA. It requires zero credit expansion. It is inflationary, but if you do that, technically you don't have to tap the long end if you don't want to. Like, most of the government funding in the bond market is at the front end. Like, even you could say you go up to 7 years, 10 years. Those auctions are nowhere near as big as like fives, threes, twos, and bills.
Yep.
So the majority of the funding is front end anyway, which the market is going to buy, right? They want lower duration. And then on the long end, you've got some natural buyers, your pensions, your insurance industry, who naturally is your willing owner of long-term IOUs because it matches the time horizon of their liabilities. So there's always some amount of funding on the long end. If you remonetize the gold, in this speculative attack that the Treasury curve would sell off, someone who doesn't like these tariff policies and wants to force a Liz Truss moment, for lack of a better kind of label, you're fighting a losing fight because we're sitting on the gold.